afternoon, everyone, and welcome to our webinar. We're going to give folks just a few more seconds to sign on, so we'll begin momentarily. Okay, it looks like we have a number of our attendees who have already joined us. I want to go ahead and welcome everyone to our webinar, Timing is Everything, 3 key areas to consider when creating your purchase timeline. My name is Beth Haynes, and I'm Director of Marketing at Nobles Pond, a 55-plus lifestyle community in Dover, Delaware. Today, I'm joined by Mark and Jocelyn Succarotte with Whitecap Mortgage. They are long-standing lender partners of Nobles Pond and have helped many of the homeowners in our community call their home at Nobles Pond theirs. Today, Mark's going to be sharing a lot of information with you, and we appreciate you joining us for this very special webinar. Before I turn it over to Mark, a few housekeeping details. This session is being recorded, so please know that you will receive a recording of it tomorrow as a follow-up. Everyone for this session is in mute. If you have a question that you would like to ask, you will see in your control panel a box called Questions. Please feel free to type your question there and submit it to the team. We will do our best to get through all questions at the end of the session, and any questions that we're not able to get to, we will certainly send follow-up references to. And as always, your participation is definitely valued, so keep those questions coming. And finally, before I turn it over to Mark, as a special thank you for all of you attending, Nobles Pond is going to be offering $5,000 towards closing costs to welcome our future homeowners to our community. And we'll be sure that you also have the contact information from Mark and Jocelyn should you have any questions or needs when it comes to a mortgage for your new home at Nobles Pond. So thank you all for being here. Please let us know if you do have questions. And now, Mark, I'm going to turn it over to you.
Thanks, Beth. Thank you, everybody, for joining us. I wanted to first introduce myself. You can see a nice little picture there of my family. 20 plus years in the mortgage industry. I am a Navy veteran, born and raised in Delaware, never left Delaware except for my time in the military. I've partnered with my wife, Jocelyn, to start Whitecap Mortgage. And so our core belief here is we believe that our customers deserve the best rate and service, and they shouldn't have to choose one or the other, right? So in my 20 years, I've worked for many companies, from large banks to smaller ones, and not all are built the same nor have the ethics that they should sometimes. So we decided to create our own company and follow this belief. So let's get started here. We've got a lot of information to cover. So I do want to encourage everyone to set a one-on-one consultation if you want to talk about more of your own personal situation, because there is a lot of information here, and so let's just jump right into this. Timing is everything. Here are 3 key areas to consider when creating your purchase timeline. Okay, so what do we mean by purchase timeline? And so I've taken an image off of our website, which you can see some more information about having a house built and how it correlates with the mortgage process, but on our website. But here's an image that really talks about the timeline during the mortgage process and how it matches up with having a house built. And so you can see here, it starts with the pre-qualification process all the way through your closing date, which a lot of times it's about 6 months for that time frame. However, your process is probably going to start, your time frame as during your preparations are probably going to start well before this, while you're planning on deciding where you're going to move and what state and all that good stuff. But for this webinar, we're really diving into the time frame with the mortgage. So quickly, let's just kind of go through some of the steps here that I felt that are important here. We got pre-qualification, pre-approval. This is where we're going to structure your loan, how we're going to get you qualified, what you qualify for, figure out what your budget is, how much you want to spend to what your payments you want your payments to be. We figure all this out in the beginning. This allows you to finalize confidently with the builder to know, what your price range is. Once you do that, once you finalize, we can do the mortgage application. That is, a couple signatures are going to be required. This is where we start verifying and supplying to an underwriter how we want the mortgage laid out at the end. And so the underwriter will approve the loan, and this will allow the builder to get started. He can start construction, and we pretty much won't have much communication until we reach your house being drywalled, painted, trims installed. So at that point, we're usually around that 3-month, 4-month mark, and we'll start updating your file again. So at this point, we're going to be updating your credit. We're going to be updating your income, making sure everything that we kind of structured in the beginning, that we start getting all that laid out. We start re-verifying that process and going through your assets, updating your bank statements. So we do that in the beginning, and then we start doing it again at the end. At this point, we order an appraisal. So this is always a question, why an appraisal now when the house isn't done? But this is typically we do it at this point to get the value, and then there's a final inspection at the end. And at this stage, we can also talk about locking in an interest rate. And then right before, usually about a week prior, when the house is done, we've collaborated with your attorney the final closing numbers. And this is the initial closing disclosure you'll receive, just so you can have an idea before closing what you can expect as far as your final cash to close and your monthly payment. We get a final inspection to make sure the house is 100% completed and get you to closing. So this is a basic timeline. And so why we put this together, because there's some key components within this timeline that affects how your decision-making process goes. And so let's talk about the 3 key areas that we felt that were important that we always face with new construction. And this is the timing of your retirement income. We're going to discuss the timing of your assets, whether you're going to be selling some assets or not, and the good time to do that. And the timing of today's market is now a good time to buy. So let's dive into the first one, is income. What we're looking at what a mortgage company is going to be evaluating when we're looking at financing. So do you have enough income? What is the source of your income? And is your income stable and likely to continue? These are the 3 main things that we're looking at for income. So let's dive into the first one. Do you have enough income? So what we're looking at here is debt to income ratios, otherwise known as DTI. You might have heard this. So mortgage guidelines, we allow your debt to be no greater than 50% of your monthly income. But to be a little bit more cautious or comfortable, 45 is a good number, but mortgage guidelines allow you to go up to 50%. So let's talk about that a little bit more, give some examples here. So example 1, let's assume your income is $5,000 per month. And I pull your credit and we show on your credit report $500 a month in other debts. That would be your car payment, maybe some credit cards, student loans, or maybe you've actually co-signed for student loans. Whatever shows up on your credit report. We're going to take a look at that. And then you get your new home, what you're trying to purchase, right? So if we assume your new house is going to cost you $1,500 a month, that means your total debt is $2,000 per month. We divide that 2,000 by your monthly income. That's your gross monthly income. And you get 40%. That's good, right? It's under 45. It's definitely under the 50. Let's take a look at an example 2. Your income of 5,000, so where it's the same assumption of $5,000 per month. You got the same credit report, that's $500. You got that same house, $1,500. But in this situation, you want to try to keep your current home because maybe you want to sell it later. You want to, get situated in your new house first, and then we're worried about selling. And let's just assume that debt is $800 a month, that obligation. So now you got $2,800 a month in obligations. So you divide that by the 5,000, and we got 56%, and that's bad, right? So in this example, we're going to want to try to restructure something, either try to eliminate some debts, increase the income somehow. But this is what we look at when we do our consultation to figure out what our budget's going to look like and how we can get you approved for the loan. So let's take a look at the next one, the source of your income. This is important as well. What's important, I brought back over the timeline because what's important is the closing date. Your income, we're going to be looking at your income based on what it's going to be at the time of closing. So this is very important when you're creating your timeline, right? Because it's not at the part of pre-approval. It's not at the loan approval. Sometimes your income is going to change from the time when we start the process until you get to your closing date. But we're going to base everything based on that closing date and what things are going to look like at that point, right? So are you or will you be working at closing time? Are you or will you be receiving your pension, receiving Social Security income, taking an income distribution, living off of retirement savings as needed? So just kind of pulling some income or some money out of your savings whenever you need it. Or do you plan on finding a job whenever you get here to Delaware? So these are important questions to ask yourself and to kind of be prepared, because underwriters and myself, we're going to be asking these same questions, and just knowing that these are the questions for your closing date. What's your income going to look like, and what's the source at closing time? All right. The third one is the stability and the likely to continue. What's the likelihood of your income continuing? Right. So the mortgage guidelines state 3 years continuance of your income. I know that, that we can never say, oh, well, if I was working, then my job's never really guaranteed past next week or even tomorrow. But when we're talking about retirement income, when we're talking about fixed income, an underwriter, the guideline states that we have to prove that there's a continuance, the likelihood of continuance, and that there's going to be at least 3 years of that income, right? So questions an underwriters will ask based on some of the sources of income that you have, right? So a pension, is it for life or does it have an end date? Income distribution, does your balance, so if you're taking an income distribution from an IRA, let's just say, we're going to need to verify that that income will last for at least 3 years. So when we're setting this up, let's just say you want to take $1,000 a month income from an IRA. We need to prove that there's going to be 36 months remaining of that income. So we need to see that there's $36,000 balance in that account to make that stable income and meet the mortgage guideline. Are you going to continue to work with a commute? So does it make sense? Doesn't make sense to an underwriter, doesn't make sense to you. An underwriter is going to ask that question. If we're planning on commuting, is there a likelihood of that commute continuing? Meaning, are you going to be able to continue that commute for at least 3 years? And does that make sense? It may make sense in your situation. You may have a place to live while you continue to work somewhere, but these questions are going to have to be addressed. So here's some 4 common scenarios regarding the income timeline. And so everybody going through this process like you're going through right now, everybody's situation is a little unique, but really I have found there's 4 main buckets that people kind of fall into with a little bit of variation. But here are some scenarios that we're going to dive into. I'm working now, but will retire when I close on my home at Nobles Pond. The next one is our income comes from our retirement accounts, and we just take money as we need it. Third one, my plan is to stay working at my current job in New York, New Jersey, Maryland, Pennsylvania, wherever you currently work at. Your plan is I'm going to still work there as I buy my house in Delaware. And the last one, I plan to get a job once I move into Delaware. All right, so let's take a look at this first one. I'm working now, but will retire when I close on my home in Nobles Pond. I'm working now, but I'm going to retire. So timing's everything with this scenario, right? So at the pre-approval stage, we're going to be looking at, remember, what is your income at closing? So we're going to need to know what does that income look like when we get to the closing, and let's prepare for that at pre-approval time. And do you have enough of the income? So on the mortgage approval, the approval is going to be conditioned upon that income starting. So when we're talking about timing and the importance of the timing of this income, it's not necessary that the income has to start at mortgage approval. So if you plan on getting a pension, it doesn't have to be at mortgage approval. It's going to be approved based on what we're telling the underwriter your situation is. And as long as the income starts before the closing date, you're okay. And so before closing, again, we're going to need to verify that your income has been received. It started and you've been receiving it. And how are we going to verify this? Right? So we're going to get a bank statement and we're going to be looking for a direct deposit is one way. And so we're going to want to make sure that you've got one receipt, 1 month receipt of that income. So let's just say we're closing in December and you plan on retiring, right? And so your retirement starts January 15th, your income. Well, that's no good. We can't use that income because we need to see 1 month receipt of that income before closing date, before we can close. So if you're getting a pension, if you're retiring and that pension starts December 1st, well, that's good. We're going to get a 1 month receipt of that. Or you start an income distribution from your IRA, we want that set up at least one time. So if we're closing December 15th, December 1st, it can start. And that's fine. That's eligible income. We just can't have it afterwards. And so this is where really when it comes into timing on preparing how your income is going to be laid out, make sure that we don't get tripped up on some technicalities on when your income is starting or stopping. Or we get an awards letter, right? So if it's a pension, we get an awards letter or documentation from the financial firm. And this really helps us show the continuance of this income, right? The awards letter is going to say that this is for life or it's going to end in 2 years. This is a temporary pension, because that can be the case. So an underwriter is going to want to know that information. We're going to have to provide it. All right, so the second scenario, our income comes from our retirement accounts and we just take money as we need it. So remember, when we're talking about income, what's important is the stability of that income and the likelihood of continuance, right? So an underwriter is going to want to make sure of that. So if we're just taking some money out as needed, right? How can we prove that that's stable and we're likely to continue, right? So really, if we're looking at this scenario, there's 3 ways that we can use your assets as income, right? So the first one, if you're not doing a regular income distribution, what we do is we'll divide the balance of your account over the term of your loan. So for example, if you did not want to, this example is clearly if you did not want to start a regular distribution, and I'm just, hey, I've got all my money's tied up in an asset, and this is what I live off of. Okay, so this example, I've got $1 million in a bank account and in a retirement account, and I'm taking a 30-year mortgage. So what we do is we divide that by 360 months, and that gives us an eligible income of $27.77 to utilize for qualifying income to be able to support your debt to income ratio. So this is one option, how we can use an asset as income. Or the other one is if you are taking distributions, annual distributions, let's just say you're not taking a monthly distribution and you're to the point where, hey, I've been taking what's required. I'm taking the minimum requirement. Maybe it's 8,000, maybe it's 12,000, whatever that is. And so we take an average of what you've done on your tax returns. And so if you've taken 10,000 for the past 2 years, that's pretty stable, right? And so the likelihood of continuance, the second part of this, is making sure that we've got the 3 years continuance. So then we're going to need the bank statement to show, hey, if you're taking $10,000 a year, we need at least $30,000 in that account because it's got to last 3 years. And so we got to check those boxes. And lastly, if the first two doesn't apply to you, hey, I don't have $1 million, or I only got 200,000 in my account, which is a great savings, but it's just not enough to produce enough income, the first method. And I'm not at the age where I'm taking annual distributions, but I still plan on taking money as needed. Well, to be able to convert this into eligible income, we have to take an income distribution. And so we start this a lot. This happens quite a bit, is that we'll start income distributions. But just remember, we need that 3 years continuance. And so we get this set up with your financial advisor as a direct deposit at least 1 month prior to closing. All right, so that covers this scenario. And I know I'm going through this fast. There's a lot of information. So I'm hoping that everybody's keeping up. But third one, my plan is to stay working with my current job in New York or anywhere that's an hour plus from Nobles Pond. So you got to commute. So does this make sense to an underwriter? Is this your primary home or a secondary home? So that's what we're going to talk about here. And this is really going to be decided at the consultation, our initial consultation. Are you actually buying a primary home or a secondary home? And what's the difference between the two of them? Right? So let's go over that. So the primary home, it's where you're sleeping. Where are you sleeping? Is this a realistic commute? This is some questions that an underwriter is going to ask to consider this to be an eligible primary home purchase. Who's living in the home full time? And are they on the mortgage? So as just quickly, a mortgage guideline to determine whether you can purchase a primary home and still work 2 hours away. Your plan is to work in New York or wherever and buy a primary home in Delaware. Now, if your wife is on the mortgage and she's moving, she's already retired or what have you, and she's going to move into Nobles Pond full time, and you're going to stay back and live and continue to work in New York, that's completely fine. You're buying a primary home that your spouse who's on the mortgage is going to be living there. That you can consider a primary home. But now if that's not the case, and if the commute is not a realistic commute, we got to look at a second home. And so what's required of a second home is just a 10% down payment. That's a minimum down payment for a second home. You get the same interest rate as a primary, so there's no difference there. Again, the only difference is 10% required. And so most of the time, everybody meets that requirement. Now, we're going to need to count your current housing expense as a debt ratio, right? So when you're talking about a second home, that means you have a primary home somewhere. I'm living in New York. I'm working in New York. That's my main source of income. However, I'm buying a home in Delaware. So when I retire at some point, we're going to transition and live in Delaware. So we've got a current housing expense. So we got to count that in your debt ratios and make sure you qualify. Now, sometimes the situation is, hey, we plan on selling our home, but we're still going to work in New York because we're not quite ready to move full time into Delaware. And so we're staying with my brother. We're staying with my daughter, my son, and we're staying there rent free. Does that make sense? Sure, it does. It happens all the time. So we just got to make sure we're documenting that. And a lot of times we'll have to get a letter just explaining your situation and making sure that we paint the picture to the underwriter and that it all makes sense. All right, so the next one. I plan to get a job when I go to Delaware. All right, so this one, a little bit more complicated. However, so remember, it's income being received at closing, before closing. We need to verify it. So if you plan on getting a job, is it being received and is it stable and likely to continue? That's what we got to look at. The other one is, hey, I plan on getting a job in Delaware when I move because my current employer is going to be transferring me, right? So we got two situations here. One is, I see the first example here that like a nurse. Hey, I can get a nursing job anywhere I go. And so I'm going to apply for a nursing position or a teacher's position once we get there. Unfortunately, we can't use that future income. And so it cannot be protected. It has to be what is being received before closing, and we need to verify it. Now, if you're transferring, let's just say I work at Lowe's and in New Jersey, and I'm being transferred to the Lowe's in Dover. Well, that's okay. That's stable. You've been working there, and so we just need to confirm that with the employer. They'll provide us an employment letter saying yes, you've been transferred, and that income is and that transfer is going to take place before closing, or at least close to that closing date. Okay, so that wraps up our scenarios. And so the next thing we want to kind of get into is assets. And what are we looking at assets? There's two really main topics here when we're talking about assets. Do we have enough of them to accomplish what we want to accomplish? And what is the source? What is the source of that asset? So first, do I have enough of savings? What's more important? What's important to know to answer this question is to understand how much money do I need? Right? Do I have enough? How much do I need? And when is it going to be due? And so let's take a look at when this money is due. You got some upfront money that's going to come due, and this is your lot hold. So you're going to need some money for a lot hold. You're going to need money possibly for the POM program. You're going to need a deposit to get the builder started. There's an appraisal fee. Once you're underway and you're going through that mortgage process, we're going to be doing an appraisal and a final inspection. So there's some upfront costs. Typically, this is the only upfront cost that you're going to have, unless you're doing some things with the builder, some changes to the contract that may require an additional deposit. But these are your upfront costs. Let's take a look at your back-end closing costs, or the cost at closing. Right, so let's just assume you've already given the builder $40,000, and we worked out the mortgage where you're going to put $100,000 down. Right, so you got the remaining of your down payment at closing. You got $60,000 plus your closing costs. Now, your closing costs are your legal fees, your lender fees, your government fees, taxes, and your escrows. whether you're having the mortgage company manage your escrows or you're going to pay your own taxes and insurance, either way, it's still an upfront cost at closing, right? So do we have enough to support this, right? So knowing now the timing of this, we can kind of look at some of the sources of our assets, right? So we need to prepare for the upfront cost and the back end cost. Do we need to liquidate some money? Do we need to sell any assets? Do we need to tap into any assets? Right. So what are some of these sources of assets that we're talking about here that we can kind of tap into, knowing that we got some upfront costs and the back end costs? So let's just say all your money's tied up in the equity of your home, right? I don't have a retirement. I just have a pension. So I don't have a 401k, an IRA. I'm living off a pension, and all of our money is tied up in the equity in our home. Well, if this is the case, you may want to think about doing an equity line on the home. And when you're thinking about an equity line, you will want to do this up front. You want to do this before you start the whole mortgage or the contract process with the builder, because once you list your home, if you're trying to list your home and sell it, you're not going to be able to get an equity line. And if the builder wants a deposit, having an equity line to tap into, knowing the timing of everything, that you're going to need some of this money up front, and having that equity line available right then and there makes that process so much smoother, and it takes a little bit of anxiety off of your plate. Now, an equity loan, you don't make a payment on until you use it. But that goes into the next thing is, let's talk about that before you actually go out and take out this loan, because we want to make sure it doesn't affect your DTI, your debt to income ratio, right? That it's not going to affect the affordability of your new home. So we definitely want to touch on that. Now, selling items, boats, RVs, jewelry. So we're touching on some of these assets that you may think about selling. We have to verify any money that goes into buying a home. So on the mortgage end, it's required of us to verify every dollar that goes into buying a house. So if you are selling a personal property, we're going to need proof of ownership and the bill of sale. So we need to prove that this money is yours. Now, all the time, you can't prove it, like jewelry. It's very hard to prove that was your jewelry. Typically you're going to have a bill of sale, but there's not proof of ownership. Normally people don't keep the receipts of them purchasing it, and here's the account that I purchased it from. So if that's the case, knowing that you're going to be using this, knowing that the mortgage company is going to be looking for proof of these deposits going into your account, you might want to think about doing that prior to the mortgage process. And that's when we're talking about seasoning. When you see that word seasoning, what that means is it's been sitting in your account before you started the mortgage process. If I'm looking for bank statements, that money has been already set into your bank account before the bank statements have been provided. So if you're going to give me April and May's bank statement, that you've deposited that in March, so I won't see those deposits. And that's what you'll want to do, get that money in those accounts. If you can't prove proof of ownership, if you can't prove it, then we can't use it. Money transfers and deposits. So again, we're going to be verifying all money that goes into the transaction. Even if you're not using it, if we're seeing large deposits go into your account, we have to verify where that money have come from. So the rule on this is, if it's more than 50% of your income, we need to verify it. For example, you've got $5,000 a month in income, and you deposit $3,000 into your bank account during the mortgage process, and we see that bank statement, and we see a $3,000 a month or a $3,000 deposit, by mortgage guidelines, we got to ask where it came from. If it was $2,000, we're not worried about it because it's less than 50%. Right? So this goes into either deposits, ATM deposits, or bank teller deposits, or even transfers. If you're transferring money back and forth, we need to follow the paper trail. All right, and then selling stocks and liquidation of funds. Don't wait too long. If we know, we're going to know whether or not you're doing this all the way at the pre-approval stage. When we submit it to an underwriter, they're going to approve it, and they're going to say proof of liquidation of stocks, right? Because that's what we told the underwriter you're doing. We can't wait till the very end. A lot of people will try to wait until the very last minute to sell stocks, and what that does is called delays, calls a delay, because there's a process to selling stocks. There's a process to getting into a bank account. Then you got to show us proof that what you did, we got to give it to an underwriter. They have to approve that, right? So that takes some time. So we really want to get that done 30 days before closing, minimum 15, but we really want to try to get that 30 days. All right. So that is about your assets. Now I want to, this is an extreme example, but we talked about transfers if you're transferring money. And I really wanted to express, because even though this seems extreme, funny enough, this happens all the time. Everybody that lives, I feel like everybody, but people that live on fixed income, we see this almost all the time. And so as long as I tell people up front what to expect, they're usually better able to deal with the questions when we ask the questions, or they have the documentation already. So let's talk about movement of money. All right, so here's a scenario. You gave a deposit to the builder of $23,500, right, up front. And so we need to verify all money going to the transaction. So we ask you for the bank statement showing that that deposit cleared. When you gave us that bank statement, it showed a $20,000 transfer from a savings account. All right, so now we need to verify where the $20,000 came from. Right, so you provide us a savings account. Long and behold, in that savings account, we see a $7,000 deposit of jewelry. And then we also see a $15,000 transfer from a money market account. So guess what? Now we need to ask the question. Okay, do we have proof of the $7,000? And can you show me a statement from your money market account showing the $15,000? Because we got to follow the paper trail. All right, so obviously you're unable to verify the jewelry, right? Because there's no proof of sale, or there's no proof of ownership of your jewelry, so we can't use it. And it's important to note, this is true for the safe money that you're keeping in a personal safe at home. If this is you and you got $50,000 sitting in a bank or in a safe in your closet, and you want to use this to buy your house, we cannot verify that money, so it cannot be used in this transaction. You need to get it into a bank account before you start the mortgage process, or else if we see a large deposit of $50,000 and you tell me it came from your safe, no mortgage company will allow that. And so it's very important you get that into a bank account. So you provide us a bank statement from your money market showing the $15,000, and now it's transferred from your IRA, and the cycle continues. So here's what's important to note, is that these transfers that you're making, hey, we're not going to stop you from making transfers. What I want to do is tell you and let you be aware that every transfer, if it's over 50% of your income, the mortgage company is going to need to verify it. And so if you know this up front, either one, you can minimize your transfers, or maybe try to do it all at once, maybe once a month versus, back and forth. And so it's just, this is good information to allow less frustration while you're going through that mortgage process. Okay. So the last topic that we're going to talk about is the timing of today's market, and is now the right time to buy a house. So here's some things on forefront of everybody's mind, top of mind. Stock market. Stock market's down. Mortgage rates. What are mortgage rates? Is it a buyer's market or a seller's market? How does that affect my decision making? Mortgage guidelines. I heard that the mortgage guidelines are tightening up right now, and is that going to affect me? Am I going to be able to even get a mortgage? So let's talk about these. So we got the stock market versus mortgage rates. So what I wanted to do here is I prepared a slide for you showing you over the last year, the 12 months, last 12 months, the S&P 500, the stock market, right? And a chart of the 10-year treasury. Why the 10-year treasury? Because mortgage rates tend to follow the 10-year treasury. So here's what we're looking at right now. The top chart, your S&P 500, and the bottom one, your 10-year treasury. As you can see, what was it, February, March, anybody with stocks, anybody with an IRA, 401k, we know what happened. We've been losing some money here. But important to note, you can see it coming back slightly. If you see, it takes us all the way, this line here, takes us all the way back to June of last year. We're really above that level right now. So we're better than really our worst of last year, not too far off of where we were last year. Yes, we've lost some money, and it is important, and it is a decision factor. But what also happens to the Treasury? We see the Treasury go down, and that causes mortgage rates to go down. So when you're watching stocks go down, mortgage rates go down, how can this affect your decision making? Well, maybe instead of tapping into retirement funds for a down payment, maybe you just look at taking maybe a larger mortgage than what you were planning on. And when I say that, it's just leading into something important because a lot of people don't know about this. It's called a recast, a mortgage recast. So what that is, it allows you to pay down your mortgage with a lump sum amount, and it resets your payment to the lower loan amount. So for example, you didn't want to touch your retirement, you didn't want to touch your stock, so I took more of a mortgage because the rates are low. Why not take advantage of low rates? And until I deem it the right time to either sell my house and come up with the lump sum from the equity of my home, or I'm taking a little bit from stocks because the stock market came back, or whatever it may be. You take $200,000 and put the lump sum on your mortgage, and you tell the servicing department, say, I want to do a recast of my mortgage. Here's $200,000, and I only want a $100,000 mortgage. Well, they'll take that and they'll reset your payment to the new lower amount, right? So you went from maybe a $2,000 monthly payment to an $800 monthly payment. That's what you wanted in the beginning, but the market just wasn't quite there where you were able to take the cash for your down payment or what have you. You just do a recast later. There's a minimum, right? So you can't come in with $5,000 and try to reset your mortgage or recast it. There's a minimum of $10,000. Usually it's allowed one time. You'll find some banks will allow it more than once, but usually it's a one-time occurrence. They'll allow you to do this. And there's a small kind of administrative fee, so you don't have to refinance. It's like a $300 to $500 fee that you pay. Again, it does not change the rate, does not change the term. It only drops your balance and resets your payment. So that's good to note. All right. And is it a buyer's market or a seller's market? Right? So what's the difference between the two? Buyer's market is more supply than demand, meaning there's more homes for sale than there are actual buyers. And then we got a seller's market, more demand than supply, meaning there's more buyers out there than there are houses for sale. Right? So all predictions, now these are predictions from analysts, trusted analysts that I've listened to over the years. They're predicting that we come out of the pandemic and jump right back into the same market that we started with, right? Low inventory with a high demand, meaning there's going to be a lot of pent-up buyers that are ready to get out there and get into a home when we're all back to a little bit of normalcy. But there's not going to be a lot of houses to choose from. So it means we're going to be right back into a seller's market, right where we left off, a pretty strong market and pretty strong seller's market. All right, so the last one here is mortgage guidelines. Is it harder to get a mortgage right now? Yeah, many lenders have tightened up their guidelines, and why? Unemployment right now, 20%, but we're not seeing the typical financial crisis as we did in 2008. This is literally a health concern. So unemployment is up right now. Forbearance, a lot of people are taking advantage of this forbearance that you're able to take advantage of through the CARES Act. However, more and more people are taking advantage of it. 3.4 million have entered into a forbearance in April, just in April alone. And so that means people aren't making their mortgage payments. And that puts a lot of stress on banks. And so what they do is they tighten up their mortgage guidelines. So who is this affecting? Buyers with credit scores under 700. Buyers with lower down payments, and buyers with unstable income. So that's who it's affecting. So there are tighter guidelines. So if you fall within, I will say, if you fall within one of those three, it's not to say that they have stopped lending, but what they're doing is there's some overlays, there's some additional guidelines maybe that we got to achieve, like some additional reserves is what a lot of the banks are now requiring for this this buyer. And it'll probably affect the interest rate that we can offer to someone that fall in there. But if you don't fall within these three, then it's business as usual. Interest rates are great, and lending guidelines have not changed for anybody that is not in this bucket. So this wraps up our webinar. I know I went fast. I know it was a lot of information. So we definitely want to open this up to questions. I don't know if there's questions out there. And so we do, want to open it up, and I want to thank you everybody for staying tuned and getting through this with me. And again, I'm available for one-on-one consultations. As you know, with the we're all practicing social distancing. So as you're doing today, just on a Zoom or a Google Hangout, we can do this as a one-on-one with you. But there we have it. Beth, Jocelyn.
Okay, thank you. Thank you so much, Mark. We do have one question, but before we get into those, because I want to give Mark plenty of time, and I want to give everyone attending time, if you do have questions, to chat them in now. But again, thank you so much for joining us. Thank you, Mark, for sharing your expertise. Please do know, as a reminder, that as a special thank you for joining us today, we are offering $5,000 towards closing costs at Nobles Pond. So I would encourage you, if you haven't already, to speak with your new home consultant or to speak with an online housing consultant, and also contact Mark and Jocelyn when it comes to your mortgage needs. And we will be sending a follow-up to this webinar with all of that contact information. But Mark, I do have a question for you. We had an individual who asked, what does it look like if you're selling a home during the construction of your home at Nobles Pond, and the mortgage or bulk of the new home purchase will be paid off on the sale of the existing?
Say that question one more time.
What does it look like if you're selling your current home while you're building your home at Nobles Pond, and the mortgage or the bulk of the purchase, which you're going to be putting towards purchasing the home at Nobles Pond, is going to be paid off using the existing home sale?
So meaning you don't need a mortgage. I mean, what it sounds like to me is that you're getting qualified. So the builder is saying, hey, before we start construction, I want to make sure that you can take ownership of the house when I'm done. And so he will not start construction unless he knows that you can take ownership. And so in this situation, what it sounds like you're asking is, hey, I don't know if I'm going to sell my house or not. My first goal is, yes, I want to sell it because I don't want a mortgage. Or if I do get a mortgage, it's going to be small. However, it's not a guarantee that you're going to sell your house. So we got to plans, and we do this all the time. We have to plan for the worst. We have to plan that your home does not sell. We plan for a mortgage. We go through that mortgage process and tell the builder, yes, he is approved, he's ready to go, and he can take ownership of this house. That does not commit you to a mortgage. You don't really have a mortgage and there's nothing that you've spent yet in relation to the mortgage during the first process, in the beginning process. So we go through
Mhm.
that, we get you approved for the loan. The builder goes on, he's building your house. Then all of a sudden your home sells. Great. And if you net out enough to just pay for it in cash, that is no problem. And people do it all the time. So and then it's just a decision. Do I keep the small mortgage? Let me just take 50,000 so I have some sort of tax write-off. Talk to my financial advisor. He would prefer me to take a small mortgage, and now is a great time to buy stocks because everything's so low. I'm going to take advantage of buying stocks right now, so I'm going to make some money, and maybe I'll do the recast later once So I would talk to your financial advisor just to advise you on the best route. But yeah, you're not committed to the mortgage, and if you sell your home and you want to pay off that, or you're not paying off the mortgage, you're just never getting the mortgage. And if you happen to sell the mortgage a week after you moved in, let's just say you had to get the mortgage and you closed,
Mhm.
and then all of a sudden you sold your home, there's no payoff. There's no early payoffs. You can pay off that mortgage as soon as you want, whenever you want. Delaware, it is against the law actually to put anybody in a prepayment penalty on a normal conventional type loan. Not unless you're looking at for outside the box type loans, you'll never have a prepayment penalty.
Excellent. So we had another question from Barbara who asked if there was a virtual way to look at the area of Dover or speak to someone that lives there. I can take that question, Mark. Barbara, if you go to our website, we actually have virtual tours of both the surrounding area of Dover, as well as virtual tours of all of the homes within Dover that Mark and his team can then help work with you for a mortgage solution if you do determine to purchase. There's also contact information on our website, and you'll be receiving it as a follow-up today, so you can reach out to our online housing consultants to continue your conversation. And Donald asked if we could explain more about the PALM program and what that is. So Donald, the PALM program stands for Peace of Mind Program. And what that essentially does at Nobles Pond is it allows you to lock in a home price today and still give you time to prepare to sell your current home. Again, there's additional information on our website about that, and we'd be happy to contact you. Mark, I have a few other questions for you. So Marcia asks, she's a New Yorker. What makes more sense, to get a mortgage from a New York bank or from a Delaware bank?
Well, I will tell you, New York they have a New York state of mind, right? I mean, it is a totally different world. And so the rules buying out in different states, and the closing cost. So what you'll find is the New York bank is not going to know some of the Delaware closing costs, some of the Delaware nuances, and they definitely won't know Noble's Pond, right? So the firsthand touch of knowing the staff and the community, and knowing to navigate through that. I don't know if your bank works weekends, but I know having somebody here local that can help you, and that's why Noble's Pond loves having us around, is because we're always available even on the weekends and to help out. But convenience, sure. New York may be more convenient to go to your local bank. However, in today's environment with technology and all that, we try to keep it as convenient as possible. But it's really about making sure you choose somebody who knows the area and the fees that are going to be attached to that mortgage, so there's no surprises.
Excellent. Thank you, Mark. Another question that we have is there a time frame at which you have to do a recast of your mortgage? If you take a 30-year, do you have to do it within the first 5 or 10, or is
Nope.
it just a one-time whenever?
It's a one-time whenever. Yeah, so the
Great.
servicing department, so it normally takes about 30 days to get set up in your servicing. So when you close, that's why you always skip a month payment. So if you close, let's just use November, For example,
Mm-hmm.
you close in November, your first mortgage payment will not be until January 1st. So they give you a whole month of December without a mortgage payment. And that's because it takes time to get the closing documents. They have to record the mortgage, and they have to sell it off to the servicer, to Fannie Mae. So there's things that are happening behind the scene before that you're actually set up within their system. And a lot of times that's why they say make your first payment the old fashioned way, write out a check. Don't get set up online and all that. Make your online payment that first payment, because you may not be in their system all the way, or that lender sometimes may sell the mortgage before your first payment. And so the last thing you want to do is send it to the wrong place. But so normally I would say, to answer your question, after the 30 days, make sure your servicer, because you're going to want to set it up with them. Do not make a lump sum payment online and assume that they're going to recast. You have to call them. You have to give them the loan number, and they have to say, oh, yes, Mr. Jones, here you are. I found you in our system. Sure. So that's really all it takes. But there's, not a time constraint on when you can, as long as they have you set up in the system, and there's no end date to it. So, yeah.
Excellent. So we have another question asking if there's any benefit to shopping around for 2 or 3 places for a mortgage. Have you found that to be the case?
Is there a benefit to it? Was that the question?
Mm-hmm.
I would always advise it, right? So as much as I want to work with you and hope that I can provide the best service, but if I were talking to my mom and she was looking to buy, I would tell her, you need to, make sure that you're getting, make sure, one, you want to find out that the person that you're talking to, that you get along with them, that they're answering, that they're being responsive, and that two, that they're
Mm-hmm.
giving you the right information, they're giving you competitive information. If you're shopping for the lowest, the cheapest, you're going to
Mm-hmm.
attach yourself with the cheapest, right? And sometimes the cheapest comes at a cost, which you're not getting them on the phone, or they're causing delays. They're not getting you to the closing table. I'm not saying that they won't, but a lot of times when you shop for cheap, that's what normally you get. So you want to be competitive. You want to find a competitive lender. You want to make sure that their fees are in line with each other. So if you are shopping, rates change daily, and the fees to the rate change daily. So if you're shopping around and you talk to one person on Friday, and then you're comparing them to another lender that you spoke to the following Friday, a whole week has gone by. The rates could have changed 0.5% within that week. So you really want to make sure when you're comparing them that you're comparing the day's rate, and that you're choosing the person that is being responsive, knowledgeable,
Mm-hmm.
and competitive. Not always the
Excellent.
cheapest.
Yes, I think that's a great point, Mark, and I think it's a great point to end on. We did have a few questions. It is 3:00. We apologize we couldn't get to everyone, but please know that I have a recording of all of the questions that are being asked, and we will make sure that we address them in a follow-up. And again, you will be getting a follow-up of this webinar with our contact information. We definitely encourage you to contact Mark and Jocelyn and their team if you have any questions about mortgages and about the process that you heard today, and encourage you to contact Nobles Pond and our new housing consultants, so we can continue your journey to a dream home at Nobles Pond. Thank you, everyone, for your attendance today, and we hope to talk with you and see you all again very soon. Thank you all, and take
Thanks.
care.